Thank you very much. My talk is going to concentrate today on the possible exit strategies for the euro. Unfortunately, almost every other day you hear one more economist coming up with his superhuman effort to save the world. And the superhuman effort, usually it's a crackpot economics. So before I actually start, I just want to define where we came from. The path to the united Europe passed through the famous 5 Maastricht criteria. If any of you remember, it was a deficit of 3%, debt of 60%, inflation of 1.5%, ERM for 2 years, and long-term yields no more than 2% above the best 3. These were the so-called Maastricht criteria. Now, only Luxembourg fulfilled all 5 criteria, with Belgium and Greece having no hope in hell. The real surprise, though, was Italy. Italy, which was a much, much bigger economy and more significant economy in Europe. Now, many of us know that it was the Italians used creative accounting and Goldman Sachs type of swaps in order to, massage the numbers. And the reason that Greece actually did the same is because they actually shared the same investment bankers. In those days, if you were working on the desk, you probably worked alongside all the Italians and all the Greeks. It was just sharing the same bankers. So if it was a mistake, and it was a mistake to let Greece in, so it was to let Germany, France, Italy, Belgium, and the rest of the countries, apart from Luxembourg. It was a political decision. The euro was a political decision. It was not a financial decision. Let's get that straight. After that, it did not help that Mr. Prodi, the famous head of the Commission, called the Stability and Growth Pact stupid when both France, Germany, Portugal, Italy, and others broke the deficit rule, the 3% deficit rule. They kept changing the rules like the kindergarten play does. Okay, so the EU basically was it was not a financial decision, it was a political decision, and we know now that the European Union or the Economic Union was a myth. The union was accelerated based on political will, a strategy which most bankers, if you remember, even the Bundesbank at the time, did not want to have a monetary union. Now, there is a debt problem not just in the periphery, but in the whole of Europe. It just exhibits, it just manifests itself in different ways. The problem is that all debt and credit crises have exactly the same features. First of all, low interest rates. In other words, cheap money which skews the economic incentives, causes asset bubbles, and misallocates the capital into unworthy causes. Then you have money creation and supply out of control. The belief that only the price of money matters, in other words, the interest rate, and not the supply, and not the volume of money. You had lax regulatory implementation. Let's be clear about it. We are in the most heavily regulated industry in the world. It was not lack of regulations. It was lack of implementation of the regulations. Can anyone tell me why a bank having 70 times leverage, like most of the UK and the Swiss banks, was escaped the regulatory foresight? I mean, I don't understand these things. It has been accused, some of them have been accused of collusion. In many cases, there were basically inexperienced regulators or just simply incompetent, and we all know about the FSA. Then there were political practices and political elites that basically skewed the economic incentives because they basically wanted to promote their re-election prospects. You just spend, 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 you pass the mess to the opposition, or simply enrich yourselves, as in the case of the kleptocracy of Greece. So in Europe, we have a debt problem. It just manifests itself in different ways. In Greece, we have a state. The state is that owes most of the money. In Ireland, we had the banking and the construction industry. In Portugal, we had the real estate and the banking. In Italy, we have the state and the local municipalities. In Germany, yes, Germany, we do have the local London's banks and the local municipalities who have huge amount of debt, which is not usually counted towards the total debt. Now, a quick reminder of the debt dynamics. These are just few of the countries. And you would see that if you sum them up, it's basically what you call pigs. You come up with about 3.5 trillion, which is more than a third of the EU's GDP. Now, at a 5% interest rate, an average of 5% interest rate, the bottom row shows how much of their GDP they should spend on interest rate payments alone. Now, Greece, before the so-called, let's say, first and second bailout, was obliged to spend nearly 8% of the GDP per year only on interest rate payments. But in Italy, Italy is not very far out. It's 5.3%, and that was before the recent interest rate rises. So you have a debt dynamics which is explosive. And the interesting thing about it is that whereas in the 70s or in the 80s, most of this debt was owned by the locals. In other words, Greeks owned most of the Greek debt denominated in drachma. Now the case is the opposite. 70% or more of the Greek debt is owned by foreigners. So as a result, that 7.7% of the GDP is an outflow. It's a blood libel. This money go out, never go back into the economy. So what are the possible exit strategies? Well, the exit strategies are known to everybody. It's not something new. Let's go through them very briefly. First of all, you have the fiscal adjustment. In other words, painful for some countries, almost impossible for others, as in probably the case of Greece. It's politically explosive, as governments are voted out of office. Every government, every country that had that entered the mechanism, the bailout mechanism, if they had elections, they lost. Then you have, the famous Taliban tax rates, which obviously are not enough, because what needs to be done is you need to reduce expenditure rather than collect more money and cause a recession. Then the other possibility is to have inflation. We all know that inflation eats your principal. Problem is that you have the vigilant ECB in there, who has the very rigid mandate of price stability of around 2% inflation, and they mean what they say. They will raise rates. Then, of course, you have the restructuring, default, reprofiling, haircut, and all the other nice words that you have to look up in the dictionary. The problem is that the devil is in the details in there, and you also need politicians with lots of guts. Then you have the monetization of debt. In other words, ECB goes to the back room and gets the Xerox machine out and starts printing money and pays everyone else. For that, they need to change the Maastricht Treaty. Or you can have a many approach. You can choose, the combination of the above. Or the last one is you have the dreaded fiscal union. The alternative, of course, would be the split or someone exiting the euro. So what are the fiscal stabilizers? Well, clearly the SGP, the Stability and Growth Pact, and the excessive deficit procedure, the EDP, have failed to live up to their titles. The surveillance of the EU countries failed as well. And then what they did is that they now introduced new rules allowing the SGP and the EDP to impose fines and sanctions. The problem is that still you need to have a qualified majority in order to impose these to the offending countries. So ECB asked to have these automatic stabilizers, automatic sanctions, but obviously the Germans said, no, we're not going to have it automatic, we're just going to have a qualified majority. Some countries actually proposed that the offending countries should lose their voting rights, but this was not passed. Some others have introduced brakes on national debts, similar to what the Spaniards voted, I think, a couple of weeks ago. Now, the flavor of the month is the independent fiscal overseeing. Now, I have it in red because I'm very skeptical about this independent fiscal overseeing for a very simple reason. If you have someone overseeing your debt, basically you have a sovereignty transfer. You have no one this guy is going to be accountable to anyone. Is it going to be democratically elected? Obviously not. So you're going to have a problem in democratic accountability, you're going to have impartiality and transparency, and you're going to have a sovereignty transfer to some unelected body who's going to dictate to you what you do with your money. Some countries have asked for collateral. If you are a bad country, you have to post more collateral. And my own version of it, if I can add it, is the version of the Brazilian fiscal responsibility law. If you don't know what it means, it's around 2001. Brazil voted a law saying that if you break the budget, in other words, if any of your officials goes out of his mandate in the budget, basically he goes to jail. Now, why can't ECB print money to the amount that they want? This is the Article 21, and I just highlighted with red the word directly there. This is what the ECB mandate is. They are prohibited from buying directly from a member state or from any other public entity their bonds. And the word directly was basically there because they didn't want to fund the countries. In other words, and this is why the ECB now said that, yes, we can buy Italian and Greek bonds because we don't buy them directly from them, but we buy them in the market. It's a violation of the spirit of the law, but not of the letter of the law. When they drafted this, they meant you cannot actually finance and save countries by buying their bonds. But because of this word directly, they got away with it. So can the ECB print money? Well, we know that the ECB would resist this option tooth and nail, basically because it requires a fundamental change of the Treaty of Maastricht, and it can only be done if there are sufficiently given guarantees by the member states that they would not do it again. Okay? Of course, it increases moral hazard because you bail out failed policies and politicians, and not basically a situation where someone is needing money for, an act of God. It damages the independence of the ECB, and it's politically dangerous. But far more important, perhaps, is this red one. If the ECB tries to buy more than perhaps 400 billion worth of bonds, then the euro system is flooded with cash, and the banks no longer need the ECB in order to set the rates. In other words, the ECB loses its first and only mandate, which is monetary policy, because banks would no longer need the ECB to borrow, for the ECB to be there to borrow money, because they would have plenty of cash in the banks. So the system is, if you buy more than perhaps 400, or I don't know the exact number, perhaps it's 3, perhaps it's 400 billion, then you flood the system with so much cash that you have no longer control of your monetary policy, which is obviously not a very good idea. Now, a lot of people have actually said, how about kicking some of the offending countries out? Well, Article 7 of the treaty actually allows for a country to be kicked out with a 4/5 majority of its members voting for someone to be kicked out. The problem is that they can only do that with respect to the values in Article 2. And if you look at the Article 2, it basically says that unless a country becomes like Mugabe's Zimbabwe, in other words, you lose your democratic rights, human rights, and the rest, they cannot kick you out. It doesn't say that if you are if you're no longer able to pay your debts, we'll kick you out. Only if you do not respect human dignity, freedom, democracy, equality, and the rule of law. Okay? So you cannot expel us. However, Greece can take a euro holiday. Okay? This is an option which is probably now or has zero probability, but it makes sense only if you redenominate all of your debts into the new Greek drachma, and then you devalue the drachma. Otherwise, why get out of the euro and keep all your debts, all your liabilities in euro, in a hard currency? There's no point, there's no upside in this one. If you do it like you can get out, then you can print some of these, which I have a copy of in here, and here's the real thing. You can pass it around to see it. It's 100 billion drachma, printed in 1943, because basically the Nazi occupation at the time stole all the Greek gold, and as a result we had about 1,000% inflation every day, so we started printing money. And this is the highest denomination, 100 billion drachma. Now, if Greece gets out and introduces a new currency, you would have obviously big problems with companies that have their own debt denominated in euro, because they won't be able to change that in drachma. You're obviously going to have a capital flight, bank runs, before the introduction of the NGRD. And then, guess what? Greece might become a truly failed state, in which case the Article 2 of the Maastricht Treaty could apply, and they could kick us out, for sure. Okay? So I don't like this scenario, and I don't think it's ever going to happen. What are the other options? Restructuring, reprofiling, default, and haircut. Let's be very clear about it. Sovereigns do not go bankrupt and liquidate, this is not a company like the East Indian company that does no longer exist. Greece would still exist with or without debt tomorrow, next year, in the next 10 years. So what you have to do is that you have to restructure your debts. And this is a standard process. It's not uncommon. All investors know that they run the risk of being restructured. And the workout must be comprehensive and must include a shared burden, because it was investment professionals, institutional professionals, who actually bought this debt. It was not me and you who actually bought this debt. Okay? They were not ignorant retail investors. They were institutional investors who took the risk. So, of course, you have to make sure that this is not a liquidity crisis, but it is a solvency crisis if you want to do that. Because if you want to do a rollover like we do right now with the PSI, it assumes that you have a liquidity problem, which is not always the case. Now, if you look at the numbers, you would probably know that Greece does not have a liquidity crisis. It does have a solvency crisis, even though the EU tries to see it otherwise. What is the hard restructuring? Apparently, the EU has prohibited the hard restructuring. In other words, the EU has not allowed Greece to default. It's not about restructuring, it's that they do not want to have a failed country within the euro. This is why everything is done so that a hard default that triggers the CDSs and everything is basically outlawed by the European politicians. Now, it's hard to do, even if you wanted to do that. I mean, there are lots of scenarios right now, like 50% haircut and all that. Yes, 50% haircut with default, proper default, or just NPV. Even if you wanted to do that, then you need to have 3 conditions. You need to have enough money to pay your pensions and salaries, which is not the case in Greece because you're still running primary deficits. And you need to actually have shielded the European banks from any possible fallout. And it's better to do it after 2013 when the ESM is in place. And the other problem is that if you do it early, then there would be no incentives for the Greeks to actually, or any other country, to do any of the structural reforms in order to transform the rigidity of their country, of their economic policies. So it is a possibility, but not right now. Okay? And of course, you have the last one, which is the danger of contagion to the other countries, which all of us know, so I'm not going to talk about it. We all know what's going to happen. What is the restructuring, the friendly restructuring, the so-called PSI? Basically, bondholders are persuaded to change their holdings with new ones. The new bonds could have longer maturity. In our case, it's going to be 30 years, lower coupons or other features. So they are always involved, it's always between a trade-off between carrots and sticks. And it may happen. The PSI looks as if it's going to happen. It's not going to solve the solvency problem of Greece. It's going to solve some of the liquidity problem of Greece, but most likely a further restructuring and a further bailout would be needed later on. However, I think this is the best possible case for Europe right now. Okay? Politicians, of course, need to convince, and they seem to have convinced with all the scary headlines you've been probably reading the past 2 or 3 weeks, all the holdouts to actually participate in the PSI. The contagion of the debt cancer, well, let's put it this way. What started as a peripheral debt crisis is now evolving as a crisis for the EU. First of all, let's not forget that the nature of the EU has changed. Now we are no longer a partnership of equal partners, the 17 sort of happy brothers and sisters in the brotherhood of the EU. Now we do have a creditor-lender relationship. This is a dangerous development for the EU. If I am a friend of yours for 30 years and all of a sudden, you are in need and I give you £1 million, no longer you're a friend of me. You owe me £1 million. And this is what has happened to about 3 European countries. The monetary union, as we know, alone cannot unite Europe. The markets are not attacking just the Greeks because of their inability to deal with the debt. They are attacking the monetary union with no fiscal or political union. Europe cannot be run by unelected commissioners. Europe needs some taxing powers. However, let's not forget that there is no taxation with no representation. Eurobond, another idea, another great idea that probably we're going to hear a lot about it. if there is a Eurobond, the Eurobond idea is not a bad one. However, what is the entity that would borrow the money? Who's going to borrow the money? Is it going to have taxing powers for investors to feel secure? You know, if I borrow money, I need to be able to tell them how I'm going to repay this money that I'm going to borrow. If that entity is not accountable to the people, we have a problem. You know, that was the reason America got the independence from the UK at the time. It's because they had no representation, even though they were paying taxes. If you actually give taxing powers to an unelected body in Europe, then you have a big democratic deficit. So, in principle, the Eurobond is not a bad idea. And I have here one of the very first Eurobonds. It's from 1897. It's from one of the previous defaults of Greece, and it's a bond guaranteed in gold, and it was guaranteed by the Kingdom of France, Great Britain, and Holy Russia. And the covenants actually are in 3 languages, both in Russian. Yes, 2 minutes. Okay. There are some ideas about the European top, in other words, or TALF, or all the other ones. Basically, you want to leverage up. You want to leverage up all the EFSF that they want. I think it's not a very good idea because, first of all, it's like creating a huge SIV, a huge special purpose vehicle, in order to solve the problem. So I'm not going to discuss it. You can look at it. Then you have this is the SPV. This is what they asked. They said, we're going to have an SPV with 50 billion. We're going to leverage it 20 times. Then we're going to have 1 trillion. And then this 1 trillion is going to buy all the Greek and the Italian debt. Okay, this is exactly the same structuring extravagant technology that I used in 2006 and 2007, you know, with Lehman Brothers and the rest, in order to cause basically a global crisis. Okay, so this is a transfer of distraction knowledge. A new European paradigm. Now, this is the bad version. I have 2 versions, the bad and the good. The bad is as simple as that. When most of the countries joined the EU and the Monetary Union, they voluntarily joined the common currency and they gave up some of their sovereignty. Now the countries are losing sovereignty to unelected bodies and institutions that take over their fiscal policy decisions. Greece was not allowed to default back in 2010, as they should. Europe, as I said, was supposed to be a club of partners, and now the relationship has changed. Greece lost its sovereignty over its debt by passing it to English law. If everything goes ahead, two-thirds of the Greek debt would be under English law, which is supposed to be, in my book, a huge sovereignty transfer to someone else. And can I ask why English law, why not European? Because simply does not exist. Okay, so why not the European Court of Justice? Okay, ECJ, and why, you know, the High Court down the road? Okay, Europe is not ready yet. So in a way, Greece is slowly becoming what we would call a vassal state. Other countries may choose not to join or even opt out if this is the European direction that we're going to. Okay? And I don't think this is what the European dream was supposed to be back in the 50s and the 60s when our grandfathers decided to, you know, unite us. That's the bad one. What's the good one? Well, the good one is to have some form of fiscal union, which is the only real antidote. In other words, yes, reduce national fiscal autonomy, but at the same time increase the democratic accountability of these institutions. What you can have is perhaps some indirect taxation on tobacco, or even some of these Tobin tax going to a pot that is controlled by the dreaded European Parliament. Yes, the dreaded European Parliament is the only elected body in the European Union. And they can actually have a say of how to spend this money, whether they're going to spend it, you know, in Germany, Finland, or Greece. So I think that the only real possible exit out of all of them perhaps would be a menu of all of them. But I think ultimately the only solution would be some form of fiscal union between the countries, even though most of the countries don't like that. And as it stands, the first country in Europe with a full fiscal and monetary union seems to be Greece. We are leaders again. Thank you.
Following 2 Greeks.